For the second time in less than 6 months, the competition regulator, the ACCC, has put the kibosh on the NAB's audacious bid to bulk up its wealth management business by getting its hands on AXA Asia Pacific's Australian assets. It was supposed to be a company-transforming deal that would again put the NAB back on a par with its bigger rivals at the Commonwealth and Westpac, who'd managed to get a couple of big acquisitions past the ACCC in recent years. In a moment, I'll talk to Peter Kell from the ACCC and NAB's Steve Tucker about the implications of the decision. But first, Neil Woolrich has this background look at how the deal came unstuck.
From the outside, all appeared calm. However, it was anything but business as usual for AXA Asia Pacific this week. The company was again forced to sweat on a decision from the Australian Competition and Consumer Commission on the National Australia Bank's $13 billion bid to swallow AXA's Australian business.
The staff are thinking about what it all means for them. The planners are thinking, how does that work for us? So they may be thinking that it's better to align themselves with somebody else. The longer it goes on, the greater the instability and the greater potential erosion of value.
However, backing up its April decision, the competition regulator has ruled against NAB buying AXA Asia Pacific, thwarting the bank's ambitions to become Australia's dominant wealth manager.
I had thought, given that the ACCC had laid down a number of requirements just a little while ago, that NAB would have done everything it could to satisfy those and would ultimately be successful. So the fact that it has fallen short is somewhat surprising and disappointing.
From my point of view, I don't find it disappointing. I find it rather frustrating that AXA, yet again, will be left in limbo when we know that the French parent, the majority shareholder, wants to get the Asian assets and sell the Australian assets. So it is rather frustrating as a shareholder of AXA.
North is also a fully functional platform.
At the heart of the ACCC's deliberations was AXA's so-called North platform. North is a type of wealth management software known as a wrap platform, an important tool for wealth managers in terms of both their competitiveness and profitability. Wrap platforms allow investors to bring their entire portfolio under the one roof and help advisors channel their clients' investments into different types of assets. NAB had agreed to offload AXA's North platform to a smaller wealth manager, IOOF, but that wasn't enough for the ACCC.
And also related to that were the distribution arrangements and the products that the ACCC really wanted to go with the North platform to IOOF, and that seems to be the reason for knocking the deal back. It seems to be all around that North platform, which curiously the North product isn't making any money for AXA at the moment.
While the big four banks all have their own wrap platforms, the wannabe fifth pillar, AMP, doesn't. It does, however, have a large advisor base, and the ACCC argues it would be AMP and not IOOF who would be more likely to build the North platform into a competitive force.
Clearly, AMP, the door is open. It'll be interesting to see if French AXA SA, will be interested to talk to them. And then I think it'll be quite important for AXA SA to put more money on the table to help support the bid from AMP, for that to be attractive and approved by AXA Australia Pacific's board.
There's speculation that any bid by AMP could be 15% below NAB's last offer, a potentially morale-sapping outcome for AXA, which continues to try and focus on its business in a highly competitive and quickly changing market.